please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
To our special pre-budget series, What the World Wants from India. And now we have Caesar Maasry of Goldman Sachs joining us. Caesar, thank you very much for joining us. Before I come to what you were expecting from India and the budget, first, your view on emerging markets. Which emerging markets are growing faster than others? Where does India figure in your pecking order?
So we are actually quite positive the growth story globally, in emerging markets certainly, but India specifically. I think last year we had a couple of implementations, obviously, domestically in India, including the implementation of GST. You had the effects from the demonetization sort of earlier in the year of 2017. So I think having sort of passed those one-off slowdowns in growth, let's call them, we see a pretty smooth path for GDP growth to pick up in India to the mid-sevens for the calendar year of 2018. So we are quite positive there. I think another important aspect here when we think about emerging market corporates, which is very different from what we see in the U.S. specifically, is profit margins or operating leverage. That effectively across the emerging universe, you've seen profit margin declines over the last few years as growth slowed. And in the last sort of 12 to 18 months, with top-line growth picking up, we're now seeing an improvement in profit margins. That's already happened in some parts of technology in particular, but there are a few countries, and again, India is one of them, where profit margins had come down and only now are starting to recover. So in the macro landscape of strong growth in 2018, we see sort of outsized earnings growth, looking at about 18% earnings growth for Indian corporates in calendar year 2018.
Caesar, but then isn't much of that in the price. 2017 was a great year for equities generally, including emerging markets. Do you see any downside risk to this great bull run?
Yeah, well, I guess the way you phrase it, there certainly are upside risks and downside risks. I mean, I would be very quick to note, however, that the strong performance we saw last year in emerging markets was indeed fundamentally justified. And the way I would arrive at that conclusion is if you look at the performance, so MSCI EM was up about 34% last year. Only 5% of that came from an expansion in the multiple, which we would associate with sort of melt-up risk, this idea that it's speculative. The vast majority of the return came from a rise in earnings growth. About 22% came from earnings growth, and then about 5% from currency appreciation. So thus far, I think it's sort of not fair to characterize this rally as, you know, a speculative bubble or a melt-up or so on. It's really been fundamentally justified. And looking forward, as we sort of discussed, we do think that growth sort of pillar stays in place. But clearly the risk is going to be one of global nature. And that effectively is, what is the big event happening globally this year? Well, it's the removal of monetary support, unconventional monetary support, whether we see the Fed raising rates, reducing the size of the balance sheet, the ECB presumably tapering the purchases in Europe. This could have liquidity effects. I think this is clearly a risk to global financial markets, but I think the key point here is that is actually also very much a DM risk. This is not a specific emerging market risk.
Caesar, are you putting any fresh money to work in India, and would you have any sectoral preferences?
Yes. So to be clear, India is absolutely an overweight market. I do think heading into 2018, the dynamics will shift slightly compared to last year. What I mean by that is last year was a great year for fixed income, obviously, in the Indian market, and you saw a huge amount of inflows, I think somewhere in the order of about 20 billion coming into the fixed income market. In part, that was buoyed by, obviously, very low inflation, also caused by low food prices. I think some of that starts to fade as we look into next year. So clearly, I think 2018 will be more equity-centric. To be clear, we have a price target on the Nifty of 11,600. So I think obviously things have moved a lot, but we're still about 6% or 8% shy of that target. So we still do see upside. In terms of the sectoral composition, again, I think this is a thematic issue across emerging markets more generally, but we would tend to rotate into some of the domestic growth-oriented names. Now, in India, you have a few of the industrial companies, some consumer companies that we like on that theme, but I think also some of the banks. And obviously, the recap program of last year should help that domestic flavor as well.
Okay. Well, you have been speaking about a Nifty target of 11,600. That's your upside target. Do you have a downside target as well, or a downside likelihood?
Well, we don't have downside targets because we do think things will be moving higher. But I do think if you look sort of historically, it's very regular that EM equities have a 10% correction during some time of the year. In fact, 2017 was basically the first year since I think the mid-1990s where we didn't see a 10% contraction at some point during the year, and then obviously subsequently you can recover from that. But so if you're generally concerned about market pullback risk, I would say 10% is usually the right amount of magnitude.
Okay. You spoke about banks earlier and the positives because of recapitalization. Are you buying the public sector banks, or would you prefer to stick with private sector banks?
So I think financials in general we actually like across emerging markets as a leverage to domestic growth. I do recognize that NPLs have picked up in a number of economies, and not just in India. But I would say at this point in the cycle, when growth is really improving, we're sort of less concerned about those NPL concerns. It's really when credit growth is starting to slow, you start to face some sort of recessionary risks, that the NPLs become a much bigger issue. So we don't really have a preference between private or public from my strategy team, but as a sector as a whole, I think, again, that's a way to leverage the domestic growth cycle, which is really where you want to be. And then the last point I'd make on that is, if we do go back to your question on melt-up risk and bubbles, when we do look across valuations, the one part that starts to look sort of frothy, if you will, is the technology space. And that's a little bit of a global concern, and that's also why I think at the margin you want to rotate from those areas into the more domestic-orientated sectors.
Okay, well, I would assume the Indian IT stocks are not in that terrain yet, probably more US stocks. But, let me come to the liquidity issue. Global liquidity is so strong that both DMs and EMs are doing well. Do you see EMs outperform developed markets in 2018?
Yes, so that is certainly a key pillar of our view. We do think that emerging market assets will outperform. Again, I think that's true in credit, but certainly also in equity. And I mean, basically the way I think about that is whatever you're getting in developed markets, you're getting at a better price in emerging. I think there's a better growth profile. There's, as I mentioned earlier, more upside in the margin, in the operating leverage component of the equity story, but also valuations. I'm not going to tell your viewers that equities are inexpensive when you look at them any sort of multiple basis relative to history. But when you compare them to developed market valuations, I think EM is still trading at a clear discount. And this really matters for your global investor who's allocating capital across the equity landscape. I think the valuations are much more compelling in emerging markets.
Okay, and the most important question, we have the big union budget next week. As an investor here, what is your biggest expectation from the budget?
In general, we obviously look for the distribution of sort of capital expenditures, expenditures more for growth as opposed to subsidies. That tends to be things that are more market friendly. But again, I would really kind of point your viewers to look globally on this issue. Fiscal dynamics in EM are basically one of the areas that have not improved so much. Growth has improved, inflation has improved, meaning it's come down in most of the economies. Current account balances, trade balances have improved dramatically. India is certainly an example of that. But the fiscal balances are, I want to say, sort of secondary in nature at the moment. Fiscal dynamics become a big issue when you come into a growth slowdown, and then we worry about how much room the government might have to act counter-cyclically. But in the current environment of a very strong global growth tailwind, I don't think the fiscal dynamics are actually the most important issue facing the market.
Okay. Well, actually, that's good to hear because that's taking away all the attention on the budget. Good to hear from you that in a growth year, that wouldn't be so much of a concern. Thank you very much, Caesar Maasry, for joining us on this special broadcast in the run-up to the budget, What the World Wants from India. Thank you very much for watching.